Hello, everyone, and welcome to Financial Accounting. Today, we're going to learn how to use financial statement information to evaluate business profitability and liquidity. This learning objective is a part of Chapter 5, the Accounting Cycle, Reporting Financial Results. The link to the chapter's playlist is posted here and in the description box. Let's start with profitability. Measures of profitability help users of financial information assess the current profitability of a company and, what's even more important, its future potential for increased profits. Profitability measures help answer questions like, did the business earn a profit or loss in the current period? And what is the business's future potential for profit? Two common measures of profitability include the company's net income percentage and its return on equity. The net income percentage is a measure of management's ability to control costs. The net income percentage is equal to net income divided by total revenue and multiplied by 100. Both net income and total revenue can be found on the income statement. The net income percentage can be a useful comparison tool to assess a business against its competitors and to compare current performance trends with historical results. Let's look at the overnight out-of-service income statement and calculate the net income percentage. Total revenue is $175,000 and net income is $39,942. Now let's calculate the net income percentage for our sample company. The net income percentage is calculated by dividing the net income of $39,942 by the total revenue of $175,000 and multiplying it by 100. The net income percentage is 22.8%. This means that the business incurred approximately 78 cents in costs for every dollar of revenue it generated. The second common measure of profitability is the company's return on equity. It is a measure of net income compared to the average stockholders' equity throughout the year. It is calculated as the net income divided by the average stockholders' equity and multiplied by 100. Keep in mind that when a ratio is calculated that has an income measure in the numerator and a balance sheet measure in the denominator, an average must be used for the denominator. We already know what the net income is. Now let's look at the balance sheet to find the stockholders' equity amount. The stockholders' equity at the end of the year is $105,942. Now we need to find out the stockholders' equity at the beginning of the year. If a company is in business for several years, the number can be found in the prior year's balance sheet. The prior year's ending stockholders' equity is the beginning stockholders' equity for the current year. Since our sample company just started the business, we can assume that the beginning stockholders' equity is equal to the capital stock amount, the amount that was invested by the company's stockholders to start the business. In our example, it is $80,000. Let's calculate the return on equity. For the return on equity amount, add together the beginning and ending balances of the stockholders' equity, then divide by 2. The average stockholders' equity is $92,971, which is $80,000 beginning balance plus $105,942 ending balance divided by 2. The return on equity is 43%. This means that the company earned an income of approximately 43 cents on every dollar of equity capital. Measures of liquidity help users assess the ability of the company to pay its debts when they become due. They help to answer a question like, does the business have assets available to pay debts as they become due? Almost all companies calculate working capital and current ratio. A working capital is a measure of short-term debt paying ability expressed in dollars. Current assets represent a company's potential cash inflows in the near future. Current liabilities represent cash outlays coming due soon. Working capital is current assets less current liabilities. Both current assets and current liabilities can be found on the balance sheet. Let's look at our sample company's balance sheet again. The current assets include cash, accounts receivable, shop supplies, and unexpired insurance. The total is $30,042. Looks like overnight auto service doesn't have any long-term liabilities yet. Therefore, the total liability include all liabilities listed on the balance sheet and are equal to $20,250. Let's calculate the working capital. $30,042 of current assets less $20,250 current liabilities equals to $9,792. The company's current assets exceed its current liabilities by $9,792. However, it is important to note here that shop supplies and unexpired insurance are not truly liquid assets. Likewise, unearned rent revenue doesn't actually represent a future cash obligation. The current ratio is working capital expressed as a ratio. The current ratio is current assets divided by current liabilities. We already found out the amounts required for this calculation. The current ratio is equal to $30,042 of current assets divided by $20,250 of current liabilities, which is 1.48. This means that the company has approximately $1.48 of potential cash inflow for every dollar of current obligation coming due. Again, this number doesn't take into consideration that shop supplies and prepaid insurance will not convert into cash and that unearned revenue will not require a future outflow of cash. Thus, some professional judgment is required when analyzing the working capital. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.